Short exercise 2-6, record transactions and journal. Juliana Sales Consultants completed the following transactions during the latter part of January. So we can click here to view the transactions, and each of them are actually listed above each journal entry here, so we don't need this open. So journalize the transactions of Juliana Sales Consultants. Include an explanation with each journal entry. Record debits first, then credits. Otherwise, you get marked wrong, and by recording debits before credits, it makes the journal transaction much easier to read. So always record the debit account first and then the credit account. Select the explanation on the last line of the journal entry table, which is right here. So here's the first transaction. Notice they've already put the date in for us. So it says Juliana Sales Consultants perform services for customers on account for $8,000. So we performed a service. So that means we need to record a revenue. And also whenever we sell something, we're either going to get cash or we're going to record accounts receivable. Now notice it says for customers on account here in the word. So this means our customers are promising to pay us later. Therefore, we're not getting cash now. So we're getting accounts receivable. And accounts receivable is what type of an account? It is an asset. So our accounts receivable is increasing or decreasing? It's increasing. Therefore, assets increase on the debit side. So we're going to go ahead and record accounts receivable as our debit account first. And that's for $8,000. And then we're going to go ahead and copy that into the credit field here as well. And again, why are we recording this accounts receivable? Because we performed services, so we have to record revenue. So with revenue, do we have more revenue or less revenue? We have more revenue, therefore it's increasing, and revenue increases on the credit side. So that's why it's a credit account. So we're going to look at something here that says service revenue. And then at the very bottom, we need an explanation for what happened in this transaction. Let's see what our options are. So performed service for customers on account. There we go. And let's go ahead and check our answer. Excellent. Now there is something that's unrealistic about this. Notice, where does it say the customer names? So if your boss ever came to you and says, okay, which customer owes us this $8,000 in AR, you wouldn't be able to tell them. So in the real world and in future chapters, we will be recording the names whenever we sell something on account to customers. Okay, so let's click OK and move on to the next transaction here. So on January 30th, Juliana Sales Consultants received cash on account from customers for $7,000. So you received cash, cha-ching, and cash is what type of an account? It's an asset. And if assets are increasing, that is a debit. So I'm going to record cash for $7,000 as a debit. Remember, the cash is just a checking account. And then, so why did we receive this cash? Well, because we received it on account, which means the customers are paying off some of their accounts receivable with us. So up here, we increase the accounts receivable with a debit of $8,000, and now our customers are paying some of that with $7,000. So we need to lower our accounts receivable, and notice up here with a debit, again, that increased the accounts receivable balance, and down here we're decreasing the accounts receivable balance. So that is going to be a credit on the right hand side for accounts receivable to lower it. And if you look at the accounting grid, accounts receivable does decrease with a credit. So remember, when a customer pays us off, we have to lower their accounts receivable with us. And let's see for the explanation down below here. We collected cash, we received cash on account from customers. Let's go ahead and check that answer. Nice work. Okay. So January 31st, Juliana Sales Consultants, that's us, received a utility bill for $180, which will be paid during February. So notice here on the transaction, it is January and we're going to pay it in February. So we're not paying it now. So this is some type of a payable, and cash will not be involved here. So let's first talk about what is the expense for. It's a utility expense. So let's see, we have a utility expense here for our first account. And utility expense is an expense, obviously. So do we have more expense or less expense? We have more. And then how do expenses increase? Debit or credit? They increase with a debit. So we will input all 180 here on the left side with a debit to increase our utilities expense. All right, now let's take a look at our chart or list of accounts. In this case here, how many different kinds of payables do we have? We have accounts payable right here, but however, you have to be careful with this company has chosen to also have a utilities payable down here at the bottom, which is more appropriate. Accounts payable, which is what most companies would use, to be honest with you, or do you use a more specific utilities payable? So we have to use the utilities payable because that's what this is for, utilities. And what kind of account is utilities payable? It's a liability. And if this liability is increasing, that is going to be a credit on the right-hand side. So let's go ahead and input utilities payable for 180. Since these are getting paid at a later date. And then we need our explanation here. So we have received a utility bill due in February. Let's go ahead and check our answer. Nice work. Okay. So now on January 31st, Juliana Sales Consultants paid a monthly salary to salesmen for $2,000. So I'm going to start by putting 2,000 here so we know that's going to be involved. And 2,000 here is a credit to balance this journal entry. And we also know cash is involved because it says we paid monthly salary. So let's talk about cash. Cash is an asset, and since we paid cash, cash is going down. And since cash is an asset, how do assets go down? They go down with a credit, so we know our right here will be cash. And so I can't put cash first because we have to start with our debit first. So cash comes second because we are crediting it on the second line. All right, and now for our debit account, we have to figure out, so why are we paying these people? Because they are salespeople. So let's see if we have like a salaries expense or something like that here in our list. And yes, we do. Salaries expense being debited for 2,000. And why is this expense being debited? Well, first of all, salaries expense, is it increasing or decreasing? It is increasing. And then how do expenses increase? With a debit. And then lastly here, we have to input our explanation. So we paid monthly salary to salesmen. Let's go ahead and check our answer. Fantastic. Okay. So now our next transaction on January 31st, Juliana Sales Consultants received $1,500 for 3 months of consulting service to be performed starting in February. Notice again, the date is January 31st, but we're not performing the service until a later date in February. And also we are being paid here. So we received this $1,500 for 3 months of consulting service. So we know cash is going to be involved. And since cash goes up with a debit and our cash is increasing, we're going to put in cash debit for $1,500 here because cash is an asset and assets go up with a debit. And then we know our credit account has to be $1,500 as well in order to balance the transaction. So what credit account will we need? Well, here up in the wording for the problem, it's important to note again that this is January. However, we're performing this service later in February. So we've received this $1,500, but we're not going to give them service until the next month. So have we earned this $1,500? No, this is unearned revenue. And click down here and input that. But let's just make sure that it makes sense that we are crediting unearned revenue. So unearned revenue is what type of an account? Because it is unearned, it means we owe them this money. So the next day, these people could come back to us and say, well, okay, we still haven't performed the services and we just want our money back. So we owe them either the cashback of $1,500 or the service. So unearned revenue is a liability. And when we look at our accounting grid, liabilities increase on the credit side. And of course, we have more liability now, so it is increasing. So that's why we are crediting this liability, this unearned revenue. Okay, and then we can go down to our explanation. So we received 3 months of consulting services in advance. All right, let's go ahead and check our answer. Fantastic. All right, and it looks like we may be on our last one here now. So we have January 31st, the owner, Juliana Benton, withdrew $1,000 from the business. So since the owner withdrew this $1,000, we know cash is involved and cash is going down. And since cash is an asset, it goes down with a credit. So we'll input a credit for $1,000 on the second line. Since debits come first and credits come second. And again, why is this owner taking money out? They are just doing a withdrawal. So let's go ahead and take a look at our accounting grid again here. And let's see, it looks like withdrawals, they increase with a debit. So that's why we're going to debit withdrawals here. So we'll go ahead and go to Benton withdrawals, owner's name withdrawals, and then we're going to increase our withdrawals with a debit. And then let's input an explanation. So we had an owner withdrawal. Let's go ahead and check our answer. Well done.